So let's start. We will be now talking about the financial sector part 2. So lecture 19. This is in continuation with lecture 19. So lecture 20 will be focusing on the financial sector part, how we have gone through changes in the banking sector. So right now in the financial sector component we are covering the banking sector, and then we will have the different segments covered later. So next 20-25 minutes we are going to talk about the banking sector reforms, how banking sector reforms have helped India in terms of driving the economic activities. So the references remain same. So like lecture 19, you can so those references are the same here. The only thing is that now we will be focusing on the major reforms that India undertook in reviving the banking sector and the changes that were occurring in the economy in different sectors, and there were different requirements coming from different sectors. So to meet those requirements, it was very necessary to implement certain policies with regard to the banking sector reforms. So the major reforms in the Indian banking sectors were initiated with the economic liberalization process. So one common name that appears in Indian economic is M. Narasimhan. His committee had created or had made a sea change in the banking sector in India. So I will be referring Narasimhan Committee 1 for 1992 and Narasimhan Committee 2 for 1998. So 1991 is really important to understand, because at that time we were taking drastic measures to expand the banking services, and then we were also focusing on the regulatory apparatus, that how these banking regulations which are going to be expanded can further be taken care. So in terms of banking sector reforms, it included following things. So it was first that the focus was on operational autonomy, and before that most of the banks were regulated by both Ministry of Finance, the banking division in Ministry of Finance, and also by the RBI. And this committee gave a clear permission which institution should regulate the banking sector, and in that Reserve Bank of India was granted permission to regulate the whole banking sector in the country. The deregulation of the interest rate, since most of the banks before 1991 reforms were functioning under the very regulated framework, and they had a lot of protections, and that is why the interest rate was heavily biased towards the higher interest rate, and the even it was quite high, and for the banks it became quite unbearable. So deregulations were made not just for the lending but also for deposit rates, that banks were given freedom in terms of deciding about the rate of interest. Relaxation in the deregulation of interest rate was also possible, because by the time when we thought about the deregulation, we had some options available for investment, because in the 1960s 70s people had a very limited option to save, and the banking was one of the major options, and that is why the rate of interest were made quite attractive at that time. But post reform period, when we saw a major change happening in different in the financial sector domain, then it was required that these banks should be given freedom in terms of deciding about the rate of interest. In terms of relaxations in investment norms of the bank, so this is also one area where the committee had focused on, and especially in terms of how these banks will be prioritizing their investment, not only firms but other activities also. For the first time after nationalization process that we did in 1969 and in 1980, we realized that it is not good to just have the public sector banks, but it was also recommended that we should have the private sector banks again, so that the bank regulators and the bank promoters will have a faith that there will not be a further nationalization process happening, and there will be a whole lot of effort to revive the banking sector. And also it was also just to make sure that the domestic banking sector works in tandem with the foreign banks. The foreign banks were also allowed, and they were allowed to operate in India. The banking sector, since it was heavily regulated, so their focus was mostly on the real sector, and they were mostly relying on the loan advances and some income generated through the investment in government securities and other thing. This committee also provided the access to the capital market, where it was allowed that they can be listed on the stock exchange, and then after that they can mobilize money for their expansion. So this one was also one of the major development that we undertook at that time, and this committee recommended that. Then we had gone for supervisory norms when we started realizing that now the banking sector is getting bigger, and if we will not be able to tackle the risk of the banking sector, then it may create some kind of a systemic risk which arises due to the failure of one particular institution or one particular large institution. If that particular institution fails, then it is likely that it will have a stronger spillover or risk spillover on other institutions. So supervisory norms were devised in such a manner that the banking sector risk can be minimized, and some kind of regulatory apparatus could be developed, so that in future, if we some unwarranted circumstances can be avoided. Then there are also a corporate governance framework, that how the banking institutions will be operated, what will be their structure, composition, what will be the composition of the board, how these board members will function, what will be their qualification, how frequently they will be thinking about certain rules, regulations. So corporate governance also came in. So it means that there was a whole lot of gigantic structure, or the focus was to revive the banking sector in a much better way, and it was also in a way the effort was made to modernize the banking sector, and not just the conventional, it should not look like conventional sector. So I have mentioned just Narasimhan Committee 1 as NC1. So Narasimhan Committee NC1 means it is about 1992. So this committee had recommended the market determined interest rate, which means that it depends upon the borrower and lender. And since the committee had recommended for deregulation of the deposit rates, right? So banks were allowed to set the interest rate for 1 to 8%. The deregulation also continued with some up and downs in the 1992 by fixing a single ceiling rate of 13% for all type of deposits. So deposit with certain maturities were different, and this particular committee recommended for certain change. In October 1997, the deposit rates were fully regulated, and RBI allowed commercial bank to decide their own interest rate on domestic deposits with the prior approval of the board of directors. So unlike earlier, it was completely focused on the short term maturity deposits, this particular committee helped in terms of setting the market determined interest rate, and this is how it helped in terms of the banks giving autonomy that what rate of interest they would like to offer. But also there was check on the monetary policy transmission process, that if the central bank is going to decide about the rate of interest, then it should pass on to everyone, and that's why the monitoring mechanism was also developed, so that a particular committee should look after that, whether the interest rate cut which has been given by the central bank, it is passed on to the beneficiaries. Lower cash reserve ratio. So cash reserve ratio at that time was 15%, and then it was reduced to 8%. So cash reserve ratio is, these are called credit control indicators, where we have the bank rate, then we have the cash reserve ratio, and then we also have the statutory liquidity ratio. So SLR, CRR. So CRR is the requirement coming from the central bank, that each and every bank has to keep some amount of deposit in the form of cash, so they will be just keeping with the central bank in the form of current account, and this particular cash will be used only in the or unwanted circumstances with the permission of the central bank. So cash reserve ratio becomes very important. If the cash reserve ratio is lower, which means that higher amount of cash is available with the bank and they will be using for loaning, and which means that money supply expansion, money supply is increasing, and if the CRR rate is higher, which means that if the cash reserve ratio is higher, banks are supposed to keep larger amount or larger percentage of their deposits with the central bank, and as a result they will be left with a smaller amount, and this will further hinder the loaning or the lending mechanism of the bank, and this as a result will control the money supply. So, there is an inverse relationship. So, if you have the higher CRR, you have the lower money supply. If you have lower CRR, you have the higher money supply. So, the inverse relationship that we see. So, this is one of the tools of the credit control that every central bank implements, and to make sure that if you want to expand your economic activity, if you are telling your banks to invest more in economic activities and help the businessmen to invest, it means that your CRR has to be lower, so that banks will have more cash, so that they can give it to the businessman. So, that is why the CRR concept became really important, and that is why this committee had recommended that this particular rate should come down 15%. Right now, if you go on the RBI, so on the towards the left side you have different rates. There you will find cash reserve ratio. So, you have reserve rates also mentioned over there. So, right now it is 3%, but at that time in 1989 it was 15%, and then in a phase wise manner it was reduced to 8%, which means that the banks were given more opportunity for going for lending. Ninth plan document also had made observations on the high maintenance of cash reserve ratio, because if you want to go for rapid industrialization, you need to have a lower cash reserve ratio, then only you will be able to facilitate the credit requirement of the industrial process. And the Narasimhan committee had also recommended that RBI central bank should rely more on the open market operations. So, open market operations are also important thing, where central bank goes for selling the lower maturity or highly liquid government bond and treasury bills. So, what typically happens is that if the central bank is going to sell the security, it means that it is selling to the financial institutions including banks. So, bank will buy those security, which means that in turn banks will be paying to the central bank, because they are buying, so they will be surrendering some amount of cash to the central bank, which in turn will reduce the money supply. In the same way, if the central bank is going to buy and not selling, buy the securities from the banks and financial institutions, then it means that central bank is going to give money to the banks, because central bank is buying, which means that you are buying and paying cash to the central bank, and this will increase the money supply. So, open market operation takes place, and this open market activity helps in terms of quick adjustment in the money supply. So, this open market operation is really important to understand in terms of money supply process. So, what the Narasimhan committee had recommended that the central bank should not just rely on the CRR, because for central bank it is easier that they will be simply targeting the banks that you now were depositing 20%. Now, you surrender us the cash reserve ratio of 30%, 40%. As per the committee, it was told that the central bank should go for open market operations. So, if you want to generate extra money, you can buy or you can participate in what is called gilt edge security market, where the buying and selling of the bonds and the securities take place. And then we have the lowering statutory liquidity ratio, it is called SLR. And this committee had also recommended the lower SLR requirements from existing 38.5% in 25% over the period. Now, we have almost I think 18% or so, but at that time it was almost 38.5%. And SLR ratio is different. In SLR ratio, it is binding on the banks that apart from CRR. So, for example, if you are going to deposit 100 rupees in a bank as per the requirement, it is if 20% is the CRR requirement, then 20 rupees it will send it to the bank. Apart from 20 rupees, now the central bank again imposes one more condition on the bank, that you have to now have 38 rupees extra added. So, 38.5 as per the requirement, 38 rupees 0.5 paisa has to be saved in the form of cash, treasury bills and gold, precious items, anything, and this will be kept separately, and then this will not be used for any kind of borrowing and lending. So, this is just to have any kind of adjustment in liquidity. Now, this also helps regulate the central bank the money supply, which means that if the SLR requirements are higher, money supply is going to be lower. If SLR requirements are lower, then money supply is going to be higher, which means that there will be more flow of credit and money in the system. So, that is why the CRR and SLR requirements are really important to understand, and how at that time Narasimhan committee had recommended for the adjustment in the SLR requirement, and it was told that it should be reduced to 25, but now we have gone for further, now we have almost 18%. And SLR was then reduced from its peak 38.5% in 1990 to 24% by June 2011. It depends upon the situation when there will be higher uncertainty in the economy, when there is a high likelihood that an economy is going down and there is less liquidity and people are looking for money. At that time the central bank cuts the interest rate and the benefits are passed to the beneficiaries, and also it also reduces or it also instructs the bank to reduce the CRR and SLR requirement, because or it simply comes up with a notification about the new CRR and SLR requirements. Then we also have the banking sector regulations. In terms of banking sector regulation, the first thing that the committee had recommended that there should be a consolidation of the public sector bank, and there should be less number of banks compared to the large number of banking system, which means that there should not be a more than 3 to 4 large banks at the internationally competitive levels. For example, Royal Bank of Scotland in UK, then you have Deutsche Bank in Germany. So, at that level 8 to 10 national banks to cater the need of the domestic economy, industrial process. Local banks whose operations would be generally confined to a specific region. Then there is recommendation for rural banks on the pattern of regional rural banks, RRBs. So, it was also recommended, and it should be limited to rural areas. Then the Narasimhan committee one also recommended for setting up a private bank. So, there should be a scope for the private bank to participate, and there will be equal treatment. So, there should not be any kind of discrimination between public and private bank, especially in terms of regulations. Foreign banks in India. So, in January 1993, RBI issued the licenses to 10 private banks to operate in the country with the minimum capital of paid up capital of 100 crores, which was revised in 2001 to 200 crore. So, which means that this banking sector regulation of the Narasimhan Committee one had given enough importance in terms of not just granting the good financial health, but also it was about the consolidation of the large banking setup, so that there should be easy regulation. But on the other hand, the opponents were not happy, because they were of the view that if you will have the large number of institutions, then it also provides in terms of variety of opportunities and options available for the savers plus the borrowers, and that is why this should continue. So, at that time this was also one argument raised by some of the experts. Then duality of control. So, this Narasimhan committee had also gone for streamlining the duality of control. It means that at that time the banking sector was regulated by the RBI plus the banking department of the Ministry of Finance, and this committee had recommended that the banking sector should be only limited to the RBI, and RBI should have the full control on the banking system in India. Then after this committee had also suggested to abolish something called selective credit control. So, under this what typically happens is that in SEC, so when we were going for the aggressive industrialization, so at that time certain priority sectors were given incentives and they were prioritized under some plannings that this particular sector will be given importance during this plan, and there will be some extra allocation of credit resources or money to a particular sector or particular industry. So, at that time it was quantitative credit control. Under this you have a CRR and SLR and the bank rate. but there was also selective credit control under qualitative. Under that, certain priority sectors were given incentives in terms of ability of money, and it later created a trouble in terms of higher NPAs, because the emphasized sectors were not able to repay, the borrowers in that emphasized sector were not able to repay the money, and this became a big trouble. So this was introduced in 1956 when we had gone for second 5-year plan, the Mahalanobis model, the second 5-year plan, and at that time we had gone for promotion of the heavy industries and also the promotion of some sectors, right. So, and in a phase wise manner, this particular selective credit control was phased out, and this was also recommended by this particular committee, Narasimhan committee. By 2004, we also focused on the monitoring of frauds, but this was not emphasized at that time. But in post 2000, we realized that it has become one of the areas to look for, and that's why the certain regulatory bodies were set up. And though in 90s it was not fully materialized, but later in post 2000 it became one of the important issues, and that's why the government has set up. So it was also the maintenance of some kind of requirement on the bank, so that their financial health should not deteriorate and there should not be any kind of unwarranted situation for the regulator, and regulator should be aware of if there are any symptoms. Then for the first time, Anti-Money Laundering Act, so task force was designed. So this was Financial Action Task Force, and this task force was devised to make sure that the inflow of money and outflow of money into the banking sector is heavily regulated, and there is a proper monitoring system. So know your customer norms were defined. So KYC norms were devised, and these KYC norms were highly useful, and especially not just thinking about the money laundering and also about the misuse of financing for terror and other activities. So then we had the implementation of Basel norms. So we have Basel is a small city in Switzerland, and there we have a Bank for International Settlement, BIS, and this particular, so in International Committee on Bank Regulation helps a lot in terms of setting up the standards for the global banking regulation. And under that we had the Basel I scenario that was introduced in 1988. In 2004 again we had the Basel II requirement. Now we are in Basel III. In Basel I requirement, there was one requirement of maintenance of capital to risk weighted asset ratio. Risk weighted asset in the sense that some loans or debt which are having collateral, their risk will be much lower compared to the non collateral loan, and that's why it became really important that how this can be. So as such, there was no regulatory provision at that time. So that's why this CRR AR requirement became really important. So what should be the minimum capital based on the certain portfolios of the loans. So at that time India took a very forwarding step, and then it had set the CRR AR rate at 9%, higher than the global standard, right. And RBI drafted the guideline for the implementation of Basel II. So in Basel II it was a capital adequacy ratio requirement. So there were in Basel II you have three regulations norms. It is called three pillars. One is the capital adequacy norm. So it is almost 8%, similar to what we had Basel I. In the second pillar, it was about the supervisory control, which means that the central bank should have the control. There should be body to look after. And third was the market discipline. So market discipline talks about the disclosure norms, that how a particular market can be enforced with a particular discipline of going for declaration of some information or some kind of regular information. So which means that Basel II norms was further modified on the part of Basel I. Under Basel III, which is not being implemented, and now because of the coronavirus pandemic, government has not gone for the implementation, but there are certain provisions. For example, there is extra buffer requirement for the unwanted situation, because after 2008-9 global financial crisis, the whole banking and financial system is now looking for a safer place where they can easily avoid such situations in the future. So there is a buffer requirement, then there are leverage issues. So those dimensions are added. So the first was only Basel Accord was only about the risk weighted asset ratio. Then in Basel, two more pillars were added. It was about supervisory, and second was the market discipline. So if you want, you can go through on the RBI website. It provides a very detailed account. And then we have the management of non-performing assets. So in case of India, the management of non-performing assets are important to understand. In every country, whenever we have the regulated banking system. So under regulated banking system, there will be focused investment, and this focused investment or prioritized investment lead to somewhere failure of the market, and that means that the government intervention sometimes bring inefficiency, and that result in the higher default of loans and loan waivers. So those requirements. So NPAs are one of the important issues in the banking sector, and why we have gone for recently a market consolidation where we had gone for the merger of banks. So this committee had also recommended for securitization, reconstruction of financial assets, and enforcement of the security interest. So under this, if the bank does not receive any kind of activity on the advanced loan or advance money to a particular entity or particular business for 90 days, then that becomes NPAs, though it will be part of the balance sheet. But if it is less than 60 days, then it is called SMA, standard it is a special mention account, and then if it is for 60 and 90, it is called SMA 2. So these are the requirements. Special mention accounts are important, that if the particular account is not having any income, then this particular account has to be monitored on not just 90 days, but also on the lower frequencies, so that at least if there is chance for any revival, then it can be processed. And this particular Act has a lot to do with the non-performing assets, and it also provided some kind of cushion regulatory norms for the banks. The Act also outlined guidelines with the cases of NPAs, even selling for. So there was a debt recovery tribunal. Then there was also some kind of setting of the, it is called asset management company. Then we had asset reconstruction companies. So ARCs. Then we had a corporate debt restructuring mechanism. So I think those things we will be discussing when we will have the Indian banking crisis discussed in detail. But as of now, what it looks like that in 2000, in the early 2000, when we were progressing on the banking sector reform, at that time also the focus was on the consolidation of the losses, regulatory process. We are adopting the new system. So overall, I think I will stop here, and I will continue in the next lecture the rest of the part. So overall, what it looked like that the Indian banking system has gone through structural changes. First, we had gone for the dominance of the government sector, then we had gone for moderation in the role of the government, and then the role of the private sector was there. And going ahead in post 2000 scenario, you will find that the focus was on the diversification. So the banking sector has been used in India for specific purposes. So in the beginning, when we got independence, the focus was more on the capacity industrialization. So the ultimate objective was that there should be financial institutions which will be investing more and more in terms of providing loan and services. Then in 1980s, we still realize that we need more financial institutions to support the growth process. So we nationalized again. In 1991, when we faced the economic crisis, very awkward situation, then at that time we realized that we should be now moving towards a more market oriented setup in terms of global rules and regulations, implementation of rules and regulations. So Narasimhan Committee helped in terms of going for restructuring of the banking sector, and the new revival era started. So now we will be into the new revival era. In the next lecture 21 and 22 we will be talking. Thank you so much.